there is one way that Donald Trump's policies could have a negative impact on the US economy, and that is through his use of tariffs that is comparable to Herbert Hoover's tariff policy at the start of the Great Depression. Herbert Hoover was elected during one of the strongest stock market bull runs in history. This was a time where corporate profits were at record highs, most financial assets were going up, but at the same time as that was happening, wealth inequalities in the US were reaching extremes, something that is not unlike what we are seeing today, with stocks making record highs at record valuations, with record profit margins, but with the average American feeling extremely pessimistic about the future of the economy. So Hoover implemented a series of policies that were aimed to combat these wealth inequalities, and that included a radical new tariff policy that many believe was partially responsible for the big crash that followed. These were called the Smoot-Hawley tariffs. They hiked the average US tariff rate to around 20%, which led to a global trade war, grinding world trade to a halt. There are countless academic research papers that have studied the negative impact that the Smoot-Hawley tariffs had on the US economy during the Great Depression. Now, the average US tariff rate has steadily been going down since the Great Depression as world trade has opened up, and for now they still remain very low, but estimates suggest that a second trade war under Donald Trump could potentially take the average US tariff rate all the way back up to 17.7%. And as we've shown in a recent video, our concern is that these higher tariffs will translate directly into lower corporate profit margins. If that happens, it would directly translate into lower stock market prices. For instance, during the Great Depression, corporate profit margins went from about 10 to 12% to 0%, which caused a 90% decline in US stock market indices. Of course, the Smoot-Hawley tariffs were definitely not the only contributing factor to this. High levels of debt, bank failures, deflation were all factors that contributed to that big crash. Still, it's generally accepted that the high tariff policy was a key contributing factor. Today, corporate profits are at all-time highs again, and it's not crazy to suggest that a large-scale global trade war could lead to a reversal of this tendency. Now, we also happen to believe that these higher corporate profits contribute to higher levels of inequality today, as shareholders are disproportionately rewarded relative to the working class. It's possible that Donald Trump's tariffs could reverse some of this, which could end up being a great thing for society, but it would likely come at the cost of financial pain as asset prices come down.